December 7th, 2023, we had an II pattern on the open, an inside bar, which, inside bars just mean the market is contracting. And we had a couple of those. These aren't all II patterns. A lot of them are just inside bars in the open. But this was another example of an II pattern. We had an inside bar. This was in August, and it led to a big bull trend. Now, there was a gap up, and we got a bullish inside pattern. So, that might be, a bit higher probability versus getting a gap up and then a bear inside pattern, but still II pattern on the open. I only have a few examples, but the last one led to a bull trend day. And this one you can see just ended up leading to a trading range. Whenever you get a doji bar on the open, it really increases the odds that you're going to have a trading range day. And yesterday was a strong bear trend day. So, I thought bears might get a second leg down, but I thought ultimately it would end up getting bought up. And, it was likely that we were going to get 2 hours of sideways to up trading during the start of the day. There's about a 75% chance of 2 hours of sideways to up trading after you get a bear trend day. The big gap up, good for the bulls. Doji on bar one, and look where it is. It's at around 45.75, and I've been talking about 45.75 on the daily chart being the middle of this tight trading range. So we're gapping up into the middle of a tight trading range, and we have a trading range bar. So you have to be wondering if today is going to be a trading range day. An inside bar on bar two. It's another doji bar. Again, I'm still thinking basically probably a trading range day at this point. And then a bear bar closing near its low on three. It's probably a credible swing sell below three, but I generally try not to trade the first few bars of the day. If you do sell below three, you're hoping to get really good follow through on four. And you get follow through on four, but it's kind of deceptive. It's strong enough, but it's not, as big as you want it to be. And it doesn't quite, there's the tail on the bottom is a little bigger than you want it to be. The bar itself is not quite as big as you want it to be. You probably wanted a bar closing somewhere down here if you were going to sell below three. And because it was disappointing, mildly disappointing on four, traders start scalping out on five. And they were able to make 4 points selling below three. You were able to make 4 points during five, but you weren't able to make 5 points. You can see traders were more interested in selling above four than they were in selling below four. So big tails on either side of five, and traders, took the short above four and scalped out during six as we went back to the entry price of the four low. So what are traders doing? They're selling below four, they're selling more above four, and they're getting out of their first trade at break even with a profit on their second trade. Six, we're in a tight bear channel. You can see from 1 to 6, we're in a decently tight bear channel. Bulls are hoping that you have this big gap up is a bull spike, and we get 2-3 legs down, and then a second leg up from the bull spike. Bears are hoping that, the spike was just a pullback. Although it's probably strong enough for a second leg, they're hoping to get a second leg down from this strong move here. 7, it's a reversal. It's a high 2, but it's not a very strong close, and we're in a 3-bar tight trading range, 5, 6, and 7, so I don't really think it's all that good. 8, if you'll notice, 8 breaks above the bear trend line or the bear channel line. So bears no longer have bears no longer have that argument that this is a big bear or this is a tight bear channel because this broke above it. So we might get a trend line break and then a retest and then a reversal. That's exactly what we got. We got a trend line break here, and then we retest it back into the trading range, and we ended up getting a reversal up on 9. 8 is not a very good sell. You're selling the bottom of a tight trading range, and if we were going to sell off, we probably would have already done it. And you're selling a third push: 1 pullback, 2 pullback, 3. And does this look like a bear trend? Not really at all. So you're selling the third push in what's probably a trading range. So it's a better idea not to trade third pushes in a trading range. 9, big outside up bar, surprise, for the bulls. And anyone who sold below 8 immediately gets stopped out during 9, and traders are buying above the 8 high and above the high of the day. It's important that 9 closes above the high of 1 and 2. I think that makes it a pretty credible swing buy. If you're buying above 9, it's a really big bar, so the risk is really big. The risk is exactly 10 points. And, so you're hoping that you're basically going to get a big swing up and that the low of the day is in. And I thought a reasonable profit target was last Friday's close, since on the daily chart it was reasonable to buy that close. But we haven't retested it yet, and it's about 20 points above, a little more. So I thought it was reasonable to buy, looking for that. You get some follow through on 11, but there is a tail on the top, which is mildly disappointing. On 10, you get a tail on the top, which is mildly disappointing. More follow through for the bulls on 11, but again, a tail on the top. So if you think about it, this is really a spike, and then this is a channel. and this is the trading range. So the market's constantly in the market cycle of spike, channel, trading range, spike, channel, trading range. And, these tails on top are indicating that it's probably a channel, and it's easier to see on a 1 minute chart. So if we go to 1010 to essentially like 1020, you can see 1010, we ended up getting the spike, and then we get the pullback. It ended up being at 10 16, 10 17, and then we get the channel and then the trading range. So, the market is constantly in a state of spike, pullback, channel, trading range. It's always, almost always in some form of that. And so you can see here that their tails on this indicate that we're probably in a channel. And then 12 trades down and it gets bought back up, but this leg down indicates that, this might be a trading range. Now, this is a spike on a higher time frame, so it's possible that once we pull back that we get a big second leg up. But you don't know how far the pullback could be. A lot of times, when you get spikes, it can pull all the way back, as it did, to the bottom of the buy climax, which is right here, which is exactly where we found support. 13, a low one short. I don't think it's a very good sell below 13. Bulls are hoping to keep the gap open with the 1 and 2 high, but I think really with the, the breakout point is what's important to them. 14, bad follow through if you sold below 13. 13 wasn't a good sell. It's a low one short and a bull trend. 15, kind of just a second leg for the bears. 1 pullback, 2 on 15. We're probably, with how strong this was, we might get another leg up, but we're probably going to get a couple legs sideways to down. 16 is a doji bar. We're probably not going to go too much higher. 16 was a bull bar for a lot of the bar, but it ends up closing as a doji bar, which is disappointing to the bulls. The bulls were hoping it was going to be a bull bar and they could buy, and we would start, maybe this was the spike, and then we get a pullback, and then 16 closes on its high, and they start to get a channel. However, the fact that 16 was not able to close even bullish is a problem for the bulls, and it's disappointing. And, we have this disappointing close, and these tails are a bit disappointing. So it's a reminder that we're probably still in a trading range because we're, fluctuating around the middle of a trading range. And we have these doji bars to start the day. Bar 17, it's essentially a third push down. So 1, pullback, 2, pullback, 3. So I don't think 17 is a very good sell. If you're a bull, do you exit longs? I don't think you have to. I think you can stay, you can hold through 17. Occasionally 17 is going to get a big bear bar as follow through, but not all that often. Most of the time it's going to end up being a trap. You're selling, that, if it's spike and then channel and then trading range, that you're selling the bottom of a trading range if you're selling below 17, so it's not all that good. Big bull bar on 18, a bit of a surprise, and 16 through 18 is a tight trading range, so you are buying the top of a tight trading range if you buy above 18, but it's probably reasonable looking for, a channel. We're still always in long, and if we were always in long and then you exited below 17, you have to buy again above 18. Follow through on 19, and then a disappointing bear bar on 20. Should bulls exit below 20? I think you probably can exit below 20. It's a double top. It's a lower high double top. And, you could also exit maybe a couple points below 20, thinking that it might trade down, trigger, and then we get an immediate reversal up. But if we trade somewhere down here, you probably have to think pretty hard about how valid your premise is. So I think a stop below 18 is fine. Stop a point or two below here is fine. Or getting out below, but you have to find a way to get out below before 21 closes. You can't really be getting out all the way down here. You probably want to get out somewhere in here or here at the latest. So what's also important to note is that if you look at 20, or at least if you look at 19, so some traders bought the close of 19 because 19 is technically a reason why the close bar. It's always in long and it's a pair of bull bars. It's not the best, but it is always in long and a pair of bull bars, and you're hoping that you're going to get a spike, a pullback, and a channel. And today's going to be some sort of bull channel. And when you get 19, a lot of those traders are disappointed. So if you when you get 20, a lot of those traders are disappointed. So if you bought above 19, you're disappointed at 20, and you can see those bulls, where's their entry price? Right here. So right when we touched it, those traders were selling out of their longs, and that's what's causing 21. And if you were, if you're long, do you want to see other bulls selling out of their longs? No, you want to see bulls aggressively adding to their longs to, drive the market higher. And that's not happening right here. So you end up getting a big bear bar closing near its low on bar 21. I think it's important that 21 also closed below the moving average. It made it a little bit of a better sell. I think 21 is a good sell. Something you have to keep in mind, though, is that the overall context of today is probably a trading range. So it's probably still a trading range. And, while you have, if you think about this too, you have 9 through 12, which is a strong bull spike. So, are we just going to reverse straight down and collapse? It's not likely. We're probably going to, find some support down here. I'm not sure what it's going to look like yet, but we probably will end up finding support. But regardless, I think 21 is a good sell. I thought 22 was a really important bar. So if this is a trading range, right, what's 22 going to do? It's probably going to do something disappointing. And I thought this tail on the bottom of 22 was disappointing for the bears who sold below 21. If you're selling below 21, you were hoping we were going to continue to collapse down. And if we're going to collapse and go against this, the bears did a good job of undoing what the damage the bulls did with this. And they did a good job of undoing that with 21 and 22. But this was mostly bull selling, and some bears will take the sell. But 22 not able to close on its low, and it's testing the bottom of the buy climax. And usually at the bottom of the buy climax, there are buyers. And so 22 does something disappointing towards the bottom of a trading range. And if something is disappointing at the bottom of a trading range, a lot of traders are thinking that we're probably going to head to the other side. And if you sold below 21, you needed it to get to, so it's at 45.7925, and you needed it to get to 45.73.75. And look where this bar closes. It closes at 45.73.75. So you needed it to get there to make a 5-point scalp. And if you sold below 21 and you get something disappointing at the bottom of a trading range, and you can exit at the market right there with your short with a 5-point scalp, a lot of traders, think this is a trading range, and they'll say, okay, fine. I'll take my 5-point scalp and I'll move on to the next trade. And that's exactly what happens. Traders see this and they see, well, I've made 5 points. You can see, and so I think I'm just going to exit and take my 5-point profit. And that's what happens here. And that's what's causing 23 is bears, buying back shorts. Can you sell above 23? I think it's kind of similar to doing something like, buying below 13 or, buying below, I don't know, maybe 14. You probably can. But the thing is, just as, the pullback here was really deep, if you were buying up here, you need to be buying more here. So if you're selling here, you theoretically need to be selling more all the way up. And I'm not comfortable doing that. And most traders aren't comfortable doing that. 24 follow through. Any bear who held short is disappointed that 23 was a bull close. So they bought back shorts, causing 24. Any, trader who is really, truly trading always in, and not willing to get out, early, basically trying to get out as late as possible, can exit above 24. I think it's consecutive bull bars. You're probably going to get a second leg down, but it's really not all that great. And so all the rest of the traders are exiting disappointed, and that's causing 25. 26 is follow through for the bulls, but at this point, it's big up, big down, big confusion. You probably can buy the close of 26, but if you're buying the close of 26, you need to get out below any bear bar, I think. If 27 is a bear bar, just get out below it. It's kind of dangerous to be buying up this high, especially when you're headed towards the top of the sell climax, and it was a pretty strong move. So there are probably sellers up here, and you pretty much know that traders who sell above this high or above this high are going to end up making money. So it's a spike, and then you can see we enter the channel phase on 27, 28, 29, and 30. But are these bars all that strong? Really? No. If you bought above 26, you were hoping it was a bull trend. And what you really wanted to see was strong follow through to the upside and big consecutive bull bars closing on their highs. And what you got was, a weak channel from 27 to 30. And so what happens is if you bought above 26, you had to have a stop one tick below 27 in order, that's your true risk right here was one tick below 27. You don't know it until the trade goes, but once you realize your true risk, a lot of those traders are going to try and get out around that area. And you can see we came up just a tick shy of what the reasonable scalping profit target was, which was one tick above 31. So once traders are almost able to get their true risk, they just scalped out. Additionally, 31 is a failed breakout of the 18 bar range. And a lot of times when you get a failed breakout of the 18 bar range, you'll test the other side. But you could argue this lower high was also a failed breakout of the 18 bar range, and that was a more credible sell. But I still personally wouldn't sell below 20. And in general, this spike is too strong to be trading against. 31, a bear bar, but not a very strong close. 32, some follow through for the bears. We probably should test back to the 30 close, and the move from 23 to 30 is probably strong enough for a second leg. More follow through for the bears on 33, but you notice there are tails on all three of these bars. 1, pullback, 2, pullback, 3, and then a reversal up. So this is a wedge on a smaller time frame. And it's parabolic. The breakout is essentially, you can see 33 essentially ends up being a vacuum test. If you look at it on a smaller time frame, we'll go to 12:10. You can see we tried to break out below the channel and we ended up failing. But what's important to realize is that when you get those consecutive tails, it's a wedge on a smaller time frame. 35, big bar, second leg up for the bulls. You know that the bears who sell above this high are probably going to make money. Also notable, if you were trading always in and you held, so let's say you bought up 26, you could have held through all of that. Around 2 to 1 of your true risk is where 34 went to. 35, bad follow through for the bulls, obviously, because I think that, these 3 bars, it's more than the bulls wanted. If this was going to be a bull trend, we might have gotten 1, maybe 2 bars down. But 33 is, a decent body, and it's 3 straight bear bars. So generally, when you get 3 straight bear bars, it's good enough for a second leg. So it's concerning to traders who bought anywhere in here that we got these bear bars. 36, it's an inside bar for the bulls. If you're a bull and you're buying above 36, you're buying a third push up high in a trading range. So you want extremely explosive follow through. The way I try to think about, what I want to see is the trade flipping the always in, right? So a trade like 21 or a trade like 9 flips the always in. So it doesn't, a lot of times those trades, since they're big bars, they're not going to go as quickly. They need more time and they go a little slower. But I think in general, when you're getting higher probability trades when you're taking things like that are with the always in, versus if you're trading something like 36, like a third push to the top of the trading range, you just need it just needs to go. You want to see a bar as big as you can possibly get. A bar like 26 is what you want to see after buying 36. And even then, a lot of traders are going to scalp. And when you get bad follow through on 37, traders are expecting bad follow through if you're buying above 36. So they're expecting to have to get out around break even. You can see any trader who bought above 34 was disappointed in 35 and 36. And so they got out around break even during 37. And any trader who bought above 36 basically just flattened at the market on the close of 37 because that's essentially their entry price and they just wanted to get out of the trade. 38, 39, 1 pullback 2, a couple legs down. We're starting to form a tight trading range and it could be a final flag for the bulls. I actually meant to add to my final flags. And tight trading ranges. So 40, it's essentially a high 2 for the bulls, but top of a tight trading range, not very good. 41, bears hoping that it's 1, pullback 2, pullback 3, and some sort of wedge, but you're selling the bottom of a tight trading range, not a good idea. Probably more buyers than sellers below it, probably more sellers than buyers above. You can see on 41. And you get 41, 42, 43, 44, but look at 42. It's up, down on 42, up, down on 43, and then up on 44. So 44 is a climactic third push trying to break out of the top of a final flag. And I don't think, that's just not a very good trade, especially with the disappointing tail on top. So when you're getting a climactic third push at the top of final flag, traders are going to use it to take profits. And that's exactly what they did. On the close of 44, traders took profits and that caused 45. 46, disappointing pullback. Traders are exiting. Any traders who are long up here probably are getting out on the close of 44. And if they're not, a lot of them are just dumping their position on 45 when they get bad follow through, causing 46. Follow through on 47. But down, up, down, up, down, up could be a wedge on a smaller time frame. We trade above on 48 and then back down, but we failed to break out of the bottom of the tight trading range. Really, it's just a test of the 33 high since it was reasonable to sell above 33 and those traders hadn't been let out yet. You can see they had 2 chances to get out. And 48 trades above 47, so 48 in and of itself could be a second leg trap. Market double bottom 49, and I guess triple bottom 50, or you could look at it as a double bottom with 48, bottom of a trading range, but a doji bar, so you don't want to take that. 51 follow through for the bulls, but not that good. 52 traders hoping it's a lower high, but I don't think it's a very good sell. It's a small bar. And when it starts to channel up like this, you need to wait for a trade that flips the always in, like 61. You don't want to be selling up here. Sorry. You don't want to be selling below bars like 52 because you're usually going to get bad follow through like 53. And you can see if you do sell below 52, you get bad follow through 53. Those traders just get out around break even during 54. 55, a bull bar, but not an especially great close. 56 outside up, but you're at the top of a trading range. Really not great. Expecting bad follow through. It's a couple legs up, so not good. 57, disappointing follow through, which is expected, but doesn't trade below. I think a lot of bulls might start exiting if it traded below. And then you get 58, seems like a climactic end to the channel. Bulls trying to get a breakout above the top of the channel, and it's probably going to fail. Usually when you try to get a breakout above channel, it's going to end up failing. 58, climactic bar, and you can see a big failure on 59. A high one on 60, but you're way too high on this channel, and this breakout's probably going to fail. And then you get a big outside down bar, surprise on 61, closing below the moving average. I think you can sell 61, knowing that, I thought 21 and 22 were oddly strong for a bull trend day. And if we continue to channel up, it probably would be a bull trend day. Additionally, it's, 3 pushes up. So 1 pullback, 2 pullback, 3. So it's 3 pushes up. So I don't really think that, I didn't think that bulls were going to get, much higher. And I thought that selling 61 was reasonable because we had untested closes, the 33 close, the 22 close. So a lot of untested closes. I didn't think we were getting here, but I thought it was pretty possible we could at least get to the 33 close. And then, you could see what the follow through looked like. And you get disappointing follow through on 62. Reminder that you're probably still in a trading range, but I still think it's probably always in short from 61. So okay to hold. 63 outside down. 64 would have been a high 2, and I think bears probably exit above 64, but you end up getting bad follow through for the bulls. So trap bulls who about to close 64, and traders aren't able to get in, and so you can see bears sold the close of 64, trying not to let it trigger, and it doesn't trigger. So 65 bear bar closing near its low and follow through on 66, but not all that great. If you sold the close of 61, a lot of traders probably would have scaled in more at the 50% pullback. You can see it was better to sell the 50% pullback of this big bar. A lot of times in trading range, when you get big bars, traders prefer to, take the trade at the 50% pullback. Because if you're selling below 61, what's your risk, right? Your 2-to-1 is all the way down here, which is, it's lower probability that we're going to get there. But if you sell the 50% pullback and you're able to get in there, your 2-to-1 is only down here, which is pretty close to the 33 close. So selling the 50% pullback on bars like these is oftentimes, a better strategy. And a lot of traders will do that, knowing that this channel up was pretty tight and it might end up getting a second leg up, which is what was happening here. So the traders sold the 50% pullback, and we got another leg down, but you can see it's 1, pullback 2, pullback 3. You could sell 65, but if you're selling 65, you're hoping for a really fast follow through and a good breakout to the downside. It seems more likely at this point that we're in a trading range. If you were selling below 61, you were probably hoping for big follow through, and the argument could be made to just wait for the follow through and sell lower, and that's reasonable too, or reasonable to sell at the 50% pullback. 67, it's 3 pushes down, and you're at the bottom of a trading range. The trade obviously isn't doing what you wanted. Okay to exit above 67. Pullback, and then, exit of 67, pullback 68, second leg up 69, trading to the top of a potential sell climax, and then we went pretty much sideways for the rest of the day. You could argue that 73, we're back to clearly always in short, and you can sell below it, but there's a tail on the bottom, and if you're selling below 73, you want really fast follow through. Like you want it to go, you don't want 74 to pretty much from the open of the bar be collapsing, and that doesn't happen. So a lot of traders exit above 74. So some traders will buy above 74, and they were able to make a 1-point scalp. 76 basically touches the low of 73. So many traders who are selling down here are let out around break even, and they're eager to buy back their shorts after bad follow through, and that causes 77. For stop entries, I thought 9 was good. From more an always in perspective, 9 was good, and you probably get out, maybe below 20 or a couple points below 20 or below 18. You could sell 21, but I thought it made a lot more sense to just scalp out with 5 points and see if you can get follow through. And you can, if not, you can exit above 23. You can probably buy the close of 25 or 26, but that's pretty difficult to do. You have to get out pretty much below any bear bar. I wouldn't trade any of this. I don't think it's all that great. And you could probably sell 61. But you gotta probably get out above 67 since it's 3 pushes down. Not the greatest day in the world for stop orders. On the daily chart, we're trying to test back up to the top of this tight trading range, and we'll see tomorrow. I'm guessing if we get above today's high, it's going to end up failing, and not be a very good buy. It was the same way it was reasonable to buy this close, and if we touch this close, we'll probably find sellers. It was reasonable to sell this close. It's the bottom of tight trading range, so it's not that great, but it is a wedge and a big strong bear bar at the top of the trading range. So you could take the sell here on this close. And for that reason, I think we'll probably end up getting back to it. But when we do, they'll probably be buyers. And yeah, that's the day.